how to adjust for no part, Abi. So let's start with that. Adjustments for net operating profit after tax. What was the first thing we mentioned? Non-cash expense. Number 2, accounting depreciation. Okay. Yeah, accounting depreciation. What did we say we should do to accounting depreciation? Add back to what? To profit. Why are we adding back to profit? Exactly, because this accounting depreciation does not reflect what? The actual wear and tear associated with what? With our asset. Number 3, increase in provision. You are writing. Increase in provision. Have I explained that already? No, I will explain that when we deduct, because it's supposed to be a deductible item. So I want to bring out the ones we are adding back first. Number 3 rather, I said what? Increase in what? In provision. All right. Increase in provision should be added back to profit. Increase in provision should be added back to profit. Should be added back to profit because provisions do not involve movement of cash. Movement of cash. Number 4, interest net of tax.
Good afternoon, sir. Please, I need to know if your screen is being shared, because I can't see your screen shared.
Others, please confirm that you can see my screen.
You can see your screen, sir.
Thank you. Please check your network. I believe it's your network. Interest net of tax.
This network is very terrible. Very, very.
Is it the one at your end or our own? Which one? All right. Interest net of tax.
Who is this? Yes.
Interest should be added back to profit net of tax. Interest should be added back to profit net of tax because interest should be added back to profit net of tax because
on your hotspot, have you on it?
Say again. Please, if you're having issues with your network, could you please log out of the class and log in again? We'll just give you 30 seconds to do that. Please log out and log in again. We are waiting for you now. 30 seconds. Log out, log in again. All right. Where did I stop? Because interest cost has been treated under WACC. Because interest cost has been treated under WACC. Number next, non-capitalized lease. Non-capitalized lease.
Good afternoon, sir. Please, we can't see your screen.
Did you log out and log in again?
Yes, sir.
And you still can't see my screen. Others, please, can you see my
It's
screen?
just showing those online.
We can't see it, sir.
It's just showing. Okay. It's showing now.
Afisuru. What's the fifth one? After this interest net of tax, what did I say? No. Lease. All right. Where a lease obligation, where a lease obligation has been expensed, where a lease obligation has been expensed, this amount should be added back to profit. This amount should be added back to profit.
Sorry, sir, can you come again? Where a lease of
Has been expensed. When it has been expensed, this amount should be added back to profit. This is because in EVA, EVA, all leases must be capitalized. All leases must be capitalized. Number next.
This is because
all leases must be capitalized. All leases must be capitalized. Number next, expense R&D, research and development costs. Expense R&D. Expense R&D. All R&D costs should be amortized. Good. Research and development costs, R&D. Research and development costs. What did I say? Should be amortized over the useful life. Over the useful life. Over the useful life. With a portion being expensed in the year. With a portion being expensed in the year. And the balance, a portion being expensed in the year. And the balance capitalized. And the balance capitalized. Full stop. Where R&D cost has been expensed, where R&D cost has been expensed in the financials, where R&D cost has been expensed in the financial, this should be firstly added back to profit to correct that error. This should be firstly added back to profit to correct that error. To correct that error. Firstly, added back to profit to correct that error. PM, to correct that error. Number next, decrease in provision. Decrease in provision. This amount should be deducted from profits. This amount should be deducted from profit because a decrease in provision overstates profit. A decrease in provision overstates the profit. Overstates the profit. Number next. Economic depreciation. Economic depreciation. This depreciation reflects actual wear and tear of an asset. This depreciation reflects actual wear and tear of an asset. Hence, it is a deductible expense under Eva. Hence, it is a deductible expense under Eva. Number next. Cumulative non-cash. Cumulative non-cash expense. Cumulative non-cash expense. This amount should be added back. Should be added back to capital employed. Capital employed. Capital employed. To correct prior year errors. To correct prior year errors. Prior year. P-R-I-O-R. Prior year errors. How many notes do you have? How many? 9, I mean. Prior year errors. Okay. So what I will do is I'll quickly just explain the points, and then I'll give you the format, and then look at questions, and then to see how it has been tested in the past. What's the first one? I think I've explained the first two. I mean, non-cash. I already explained that non-cash. I mean, non-cash expense. They are actually non-cash, Abi, and then they don't reflect what? They don't reflect actual movement of cash. And remember, EVA is about what? Real economic value of what? Of business, right? What's the next one? Accounting depreciation. I explained this yesterday, and I did mention that accounting depreciation is just what? It's done just to comply with a policy in accounting, Abi, just to spread cost of an asset over the useful life. But in real sense, it doesn't reflect what? The real decline in the value of your asset. And so when you see it in any financials, what do? You disallow it. Disallowing it means that I need to add it back to what? To profit. Are we together? What's the next? Increase in provision. Now, what's an increase? You know how provisions work. I mean, provision for, let's say, 2026, or let's say 2025, is 20,000. What do? I debit profit or loss in 2025, and then credit a liability. I mean, so that money will be sitting there. In 2026, I now have an additional provision, let's say 5,000 here. What do again? I will debit profit and loss for 2026 without 5,000, and then credit that same provision with how much? Without 5,000. So it means that what you have in that provision account in the balance sheet is cumulative values. Am I correct? But the one you're debiting every year, what is it doing? It's reducing the profit for the year. So now, because of the issues or problems around provision and how people or companies have used provision over the years to manipulate financials, Eva is saying that, look, when you see provision, it doesn't involve movement of cash. It's just you trying to just provide for something. Eva is saying that when you see increase in provision, what does that mean? Increase in provision means that your profit has been understated, Abi. Because when you provide, what do? You debit your profit or loss to reduce that profit. Eva is now saying, what do you do to it? Add it back so that you bring up that profit, right? When you now see decrease in provision, what does it do to your profit? It increases your profit. So what do? Never. You remove it so that to bring that profit back to what it's supposed to be. So basically what we are doing, when there's increase in provision, what do? Add it back. When you have decrease, what do? You deduct it. Two ways that can be tested. One way, they will tell you provision between 2025 and 2026 is 13,000. Simple. What does that mean? It means between 2025 and 2026, there's an increase in provision of how much? 13,000. What do I do to it? Add it back to profit. Another way it can be tested is when they give you a balance sheet, comparative balance sheet over years. Now, let's say you have 2024, 2025, 2026. And then I'm told that this is the provision. Where do I see this? This is the balance sheet. Remember, the value in the balance sheet, they are all cumulative values. Remember, just like I explained. Because when you debit profit or loss, you credit provision. Next year again, you debit profit or loss, continue to credit that provision account. Now, let's say that 2024, provision was 30,000. 2025, provision is now 35,000. 2026 provision is now 20,000. And then the question says compute ever for this maybe years, as the case may be. If I'm computing ever for 2024, there's an increase in provision of how much? 30,000. In the statement of ever for no part of 2024, think 30,000 must be added back to the profit of 2024. True? Why? Because this is when you are starting, Abi, and this amount will have been expensed in 2024. What should I do to it? Add it back. But in 2024, 2025 ever, look at what we have here. Remember that this 30,000 is sitting inside here because these values are all cumulative values. So it means that in 2025 ever, what I should have here should be how much? 5,000. So incremental provision here is how much? 5,000. So in 2025 ever, what do? I will add back what? 5,000 as incremental provision. Now come to 2026. What has happened here? The deal, how much? 15,000. What has happened? It has reduced, Abi. So it means the profit of this year is already overstated by this 15,000, Abi, because they will have written back 15,000 to the profit or loss to disallow the provision. So what are we doing? We need to do what? Deduct this from that profit. Do you understand? So two ways. One way, they will tell you provision is 10,000, 3,000 between this and this. Straightforward. Another way is where they now give you a balance sheet. Don't forget. Balance sheet, how do you see it? You see profit statement, and then you see statement of balance sheet, and then they now give you respective years. The provision that you see there or non-cash expense you see there, they are all cumulative. And then when you are trying to calculate ever and you want to adjust your notepad, please take note that what should matter to you is the incremental between the years. Between 2024 and 2025, incremental 5. Between 2025 2026 incremental how much? 15,000. And then you treat accordingly. Are we good? Online.
Yes,
Yes,
sir.
you're good.
Fantastic. Too smart to be in this class. All right, what's the next item? Interest net of tax. That's straightforward. Remember our ever. WACC equals to cost of equity multiplied by I mean, then there's one part that is having cost of debt. Do you have it in your notes? WACC formula, do you have it in your notes? There are two parts in WACC formula. Now, go on. You don't have it yet. WACC. You need to finish it down. You only have it. This WACC formula is standing on one leg. You don't have it too. Okay, do you have it? Yes, you have it. Yes, you have it.
Is it the one of debt to asset ratio?
Yes. In that one formula, you always have two sides. We agreed in the class that WACC equals to cost of equity times what? Value of equity over VO, Abi. VO plus what? Cost of debt, value of debt, VO into 1 minus T. Right. Now, what does this thing mean to us? WACC. I remember explaining to us that WACC is the weighted average cost of pulling your resources together to do the business, which we agreed that you can make money or get money from where? Equity, or you can get money from where? Debt. So what it simply means that the amount you're paying on debt is already factored into this WACC, Abi, because there's a cost of debt here. So we are now saying that where you have interest that has been expensed in your financial statement, what you should do is to add back that interest net of fact. You don't double count. Why? Because that cost of debt has been factored in our WACC. If you look at the formula for EVA, look at it. This WACC already has interest. Abi, this has cost of equity and also has cost of debt. Is that not? So it means the cost of raising equity and the cost of raising debt is already factored into WACC. And if you multiply that by your economic capital employed, it gives you the economic imputed cost. So there's no need to expense interest again in your profit. If not, if you don't counting it, you expense interest here. Also, there's interest here. So we are now saying under EVA, what do? Add back that interest that has been expensed, but what? Net of the tax. So you are. All right. Next item. Non-capitalized lease. In EBA, all kinds of leases must be what? Capitalized. If you're doing a part, how many types of leases do you have? Eh? That's what are they? Operating lease and what? And finance lease. And they will tell you all finance lease capitalized, all operating lease expense. We'll be saying it. We want to tell them that, look, all the leases should just be capitalized, because the truth of the matter is you have a control over this asset. Why not capitalize it? Because at the end of the day, you are trying to see how you are generating the profit. So you want to look at the assets that you are actually in control of. Why not capitalize it? I said, no, let's capitalize only finance lease. But recently, I think in 2019, that the old lease story changed. I mean 2020. Recently, it changed. And they said, now in your financial reporting, all kinds of leases, all kinds of leases now is what? They are all finance leases, except for leases of infinitesimal value or leases of lower than what? Lower than one accounting period. So all the leases are now what? Are now finance leases. And so if you look at the FR now, your leases, all of them are seen as finance leases, except for leases that are not up to one accounting period. So in EVA, all our leases are what? Are capitalized. So two things now. So where you now have a lease that has been expensed, if you know that all of them should be capitalized and they have expensed it, what should I do first? What is the treatment for lease? I need us to understand it. Please don't cram anything. Just follow. What is the default treatment for lease? All leases must be what? Capitalized. Abi, if you are capitalizing something, do you see expense it? They now told you in financial statement that lease of this amount has been expensed. What should you do first? You add it back, exactly, crediting expense, so that you can nil it off, Abi, to correct that error. Then what are you now supposed to do? You carry it and now what? Capitalize it. Do you understand what I'm saying? So it means the question you must ask yourself is, this lease that I'm seeing in this question, what have they done to it? Has it been expensed yet? If it has been expensed, what do I do first? Add it back to profit and then take it and capitalize it in capital and slot. If it has not been expensed, they say this lease of 18 million was omitted from the financial statement. What should I do? Carry that 18 million and do what? Capitalize it. You have a question? Okay. Do you understand? Some people have not gotten it. Should I say anything?
So please, can you re-explain the non-capitalized list, please?
All right. What is the default position for lease? All leases must be what? Capitalized. They now gave me a question. This thing will come in additional note. I'll show us now when we open a question. They will tell you, note 1, lease of 18 million was omitted from the financials above. What does that mean? It means they have never considered it. What do I do? I'll go to my default position. Okay, if they have omitted it, what was I even supposed to do to this lease? I should do what to it? Carry the 18 million to where? Capital employed. Carry it to it. And that ends that note. Another note says, lease of 18,000 naira or 18 was expensed in the statement above. Your work is now 2. Number 1 work is to do what? Correct that nonsense that they have done. By doing what? Add it back. When you add it back, you need other effects, right? The next thing to do now is what? Carry that lease and do what? And capitalize it. So it simply means that whatever thing you're going to be doing will depend on what they have done to that particular transaction. Do you understand what I'm saying? No, forever, never. You won't see that. Even in financial reporting, no lease now. They won't tell you somebody is leasing something for the place you're saying. If you're renting an apartment and you say you're leasing it, what do you say you are doing? You go renting, Abi, because it's just for a short period of time. So you can't stay in one place for 6 months and you say it's lease. It can never be lease. So you just expense it because it's within our one accounting period. Abi? So you won't see that complication ever. You won't, even in FR, you won't see it. Yes, what's the question? Online, what's your question, please?
Sir, can you hear
Yes,
me, sir?
yes, go ahead.
Please, my question is on this interest net of tax. I didn't
Yes.
understand the what you said regarding interest and work. I
Okay.
didn't
We
understand. I
said
didn't get
that
that.
interest, when interest has been expensed, you need to add it back net of tax. And the reason is because interest has already been catered for under work. You look at the computation of work, it has the cost of debt already. So you cannot charge interest twice in a statement. That's double counting. So where they have expensed interest, you add it back to your profit net of the tax because work is already taking care of that. Is it prayer time? All right, please, let's go for prayers. 10 minutes, right? All right, let's go for prayers. While we wait for them, if you have any question, please let me hear. Do you understand now? Online?
Yes, sir.
Yeah.
Yes,
Okay.
sir.
Yes. Okay. Okay, so first and foremost, let's understand what provision means. All right, provision affects two statements. How many statements do you have in accounting? There are 5 statements. Statement of profit or loss, statement of balance sheet, statement of changes in equity, statement of cash flow, notes to accounts. The primary ones that everybody is interested in: profit or loss, cash flow, balance sheet. Sharp. Every time there's a provision, it affects 2 major accounts. It will never appear in your cash flow statement. Why? Because they're non-cash entry. You see them. And when you are paying cash flow and you see you want to adjust, you add it back and do all those adjustments to take the effect out. But in your statement of profit or loss, the impact of provision is when there's an increase in provision, it reduces your profit. Is it not? What do you do? What is treatment? You debit profit or loss. Let's say year 1. My provision is 20,000. Accounting wise, what's the treatment? Debit, profit or loss. How much? 20,000. Credit what? Provision. How much? 20,000. This account is closed for that year. Year 2, there's additional provision. Let's say it's now 10,000. Additional, don't forget, 10,000. All I'm saying is this provision in year 1 was 20,000. But we have done a reassessment. I will say, oh, this thing cannot be 20,000 again. No, it has to increase by 10,000 extra. What should I do again? Year 2, debit, POL of year 2. Don't forget, this is POL of year 1, Abi. This is POL of year what? Year 2. How much? Debit is 10,000. Credit what? Provision. How much? 10,000. If you have a journal or ledger where you're keeping track of this provision, first one, you have provision, Abi. Provision, credit item. So you have first one, year 1, provision, how much? 20,000. Year 2, how much? 10,000. By the time you're closing this provision book, you have how much? 30,000 as cumulative provision that you have made. Do you understand this? Anytime there's a decrease in provision, let's say year 3, provision, I'm not saying that there's a reassessment of this provision. Let's say provision to decrease by, let's say, 15,000, for instance, right? Decrease by 15,000. So we are saying that this 30,000 that we have is no longer supposed to be 10,000. Rather, it should be 15,000. So we are saying reduce that provision that you have made by 15,000. What do we do? Simply, you debit that provision. Remember, it's a credit item, right? By how much? 15,000. Then credit what? Profit or loss. How much? 15,000. If you come to this provision, it will come to this debit side, 15,000. So that your balancing will be how much? 15,000 cumulative that you'll be having. This is how provision you work rather in accounting. So over the years, managers, smart people have been using this provision to achieve what they want. When they see that their profit is so much for a particular year, what do? They try to create fictitious provision. When you create a provision, what is the impact on the profit or loss? It reduces it. Let's say that you want to make a profit of 200 million for a year. You now made a profit of 300 million. It's too much already. So 200 million is your target. So instead, you don't know how next year will be. Instead of just showing the entire 300 million you have made, you want to reduce it to 20 million by creating how much? A provision that will reduce that profit. So people now create provision and all that just to manage your books. Eva is now saying, no, when you have a provision, you need to take the effect out of your books because it doesn't involve movement of cash. So we are now saying, anytime there's a provision increase, what it does is that it understates your profit. What should you do to that? Add it back. When there's a decrease in provision, what it does is it overstates your profit. What do? You deduct it. And I said there are two ways that your examiners give provision to you. Number one, provision between year 1 and year 2 is this amount, is 3,000. Decrease in provision between year 2 and 3 is this amount. That way you can just treat directly. When it is increased, add it back. When it's a decrease, deduct it. Another way they will now give to you is that they will not give you the impact on the profit or loss. They will give you the impact shown on a balance sheet. Remember, balance sheet is this one I'm seeing here. What you see in balance sheet, there is the cumulative value, not the one for each of the years, right? So it means if I now have provision for year 1, year 2, and then year 3, provision here, 20,000. Here, it was 30,000. Abi, from what we did, Abi. And then here is now how much? 15,000. And I'm now preparing Eva. Let's say for year 1. Eva for year 1, what do I do to this provision? Add back to what? To profit, Abi. How much is it? 20,000. Eva for year 2, remember, it's not the entire 30,000 that is showing in the profit or loss of year 2. How much is showing there? 10,000 increase. So what do? I will add back how much? 10,000. Year 3 also, between this and this, how much? What happened? There's 15,000. You mean they deducted 15,000, Abi? What should I do again? Deduct this amount. From where? From profit. How much? 15,000. That's all. Yes. The lease. The lease. Operate could be operating lease, could be anything. They were just expensive. Are you back? Okay. Yes. Please mute your mic. Mute your mic. What do you mean? Okay. So as far as the VAR is concerned, the amount of depreciation will be given to you. Accounting depreciation for the year or for the period was 20,000. Economic depreciation was 45,000. They will give you the figure. But we are talking about how it is calculated. Accounting uses, I think, 3 major methods: the straight line method, the sum of digits, and then the reducing balance. But when it comes to the economic depreciation, even though we don't use it in accounting, it is the one that this machine hour depreciation, where you have to depreciate an asset based on how long or how far that asset run. If you have 2 machines and one runs for 12 hours, another one runs for 6 hours, you need to depreciate them based on the hours that they have run or something like that. We don't use it in accounting, but just in case, but that's basically how to allocate the depreciation. But forever, they will give you the amount: economic depreciation, accounting depreciation. Just adjust the figures. Yeah. All right, so let's quickly go into the format of Eva. Format. Remember our EVA formula again, so it will guide us. EVA, no part, Abi, minus what? Help me. Economic capital employed multiplied by what? Work. Please take note that the capital employed to be used must be capital employed at when? At the beginning of the period. At the beginning. Now let me explain. How do you calculate capital employed? Total asset minus what? Current liability. Fine. So if they now give me a balance sheet, right? 2025 balance sheet. The total asset I'm seeing in that 2025 balance sheet, is it opening or closing? Closing for 2025. If I want to compute ever, will I be able to use that? I will not be able to. It means I need to do either of one, checking for 2024 financial statement, which is the balance sheet of 2024, because that's where I can see total assets, right? Closing total asset of 2024 is the opening total asset of what? 2025. Where that is not given to you, but I don't think I've seen anyone like that, where you have to start doing adjustment to go back to capital employed opening. I don't think you see that. But basically, note that capital employed that you must use should be capital employed at what? At the beginning of that period. So now let's get the format of no part. We are taking no part first. So we have, so profit after tax, profit after tax as per question. No thinking. Just go to the question and pick that figure there. Abi, where do you see this figure? Which of the statement do you see this figure? Profit or loss, Abi? Fantastic. Profit after tax as per question. Next one, add back. What was the first item? Those notes that we wrote. So yeah, let's start. First one is non-cash expense, Abi. Non-cash expense. Chen. Next, accounting depreciation. You sabi book. Depreciation. Chen. Next, figure. Tell me. Increase in provision. Next. Interest net of tax. Now, how do you calculate that? All you're doing is just interest multiplied by 1 minus the tax rate. This is how you do this interest net of tax. If the interest were 4,000, for instance, you'll be multiplying 4,000 by 1 minus t. Do you understand? Exactly. So I have a figure here also. Next. Yeah? Okay. Expense lease. Next. Expense R&D, Abi. What else? Okay, so that's we have this figure, Abi. Then we now have less. Deduct. What was the first one? Decrease in provision. What else?
Sorry, sir, this expense list, is it the non-capitalized list?
Yes, please. I will explain
Okay.
that in a bit. I will explain that shortly. And then amortize R&D. Any other one? That one is for capital employed. And then this becomes my net operating profit after tax. Chi. Amortized R&D. Now, let me explain. If you look at what I did here, can you see these two things? I've qualified them as expense. So it simply means that what you should do is to look at this your profit after tax that you're picking here, right? First, you now want to see the items that have been charged into the profit after tax. For instance, I'm seeing profit after tax, but these items are below profit after tax. It means I can't add them. I don't even get, do you understand what I'm saying? Because what I'm trying to do is that I want to knit up the effect of this expense on my profit after tax. So if they are not part of what the expense in profit after tax, it means I can't bring them in here. I just go straight and treat them the way it's supposed to be. How is it supposed to be this? I'm going to capitalize this, right? So if it has been expense, how do I know if it has been expense? Maybe the note will tell me that this amount has been expensed in the profit above, or I'm seeing it that is above the profit after tax. If it has also been expensed, what should I do? I need to add it back. That's how I'm qualifying it. Second, expense R&D. Two ways also. How do I know? You see R&D cost for the year, the expenses. I'm seeing it above the profit after tax. It means the expense. Another way is that in the note, R&D of 20,000 was expensed in the statement above. I also need to add it. But where the statement is silent and they just say R&D of 20,000 was not considered above, do I need to expense it? No. Do I need to consider it rather? No. I'll just simply go where? Capitalize it. And how do I capitalize R&D? First thing, you must amortize it over what? Over the period. Right? If the R&D is supposed to last for 5 years, I must what? Amortize it. The only portion that is hitting your no part is just one portion that relates to what? To that accounting period. And that's why you have this guy here. Can you see this? Deduct. Amortize what? R&D. Show you what? Anybody struggling? Sharp.
So please, what's the R&D, the initials?
The definition of R&D.
The full meaning.
Somebody online, please help me. For a bottle of Fanta.
Research and development.
Fantastic. But you are not here for your Fanta, sorry. All right, research and development. So basically, this R&D will mean long-term expenses. Marketing can be part of it. A lot of the R&D, research, development, marketing expenses, all of them, they fall under this R&D cost. Yeah. All right, so we are done with no part. Next now is to go to where? Economic what? Capital employed. Yes. Yes. When you amortize, you charge the balance, you charge one value, one portion to the profit, no part of the year you're working on. The balance is what you are taking to capital employed. Let me say that. Scenario 1. Look at this now. R&D of 60,000 for 6 years was not considered in the statement above. This is the first scenario. Where do I see this? You see all the notes. When they give you the statement, you see notes. Note 1, R&D of 60,000 for 6 years was not considered. 2015 is the first year of blah, blah, blah. You see all those notes. Now, what do? I know that the first setting for R&D is that I should amortize it, right? Charge one amortized value to the profit for the period, and then the balance is capitalized. What do? This one, they've not expensed, they've not considered anything at all, right? What should I do? Amortize. Amortized value, simply 60,000 straight line, divide 6. How much is it? 10,000. So this 10,000, I will take it to no part. When I'm trying to do adjustment for no part, I will deduct amortized value of what? R&D. How much? 10,000. I'll take it out. Then, when I get to capital employed, economic capital employed, I'll say R&D not capitalized. They've not capitalized it. What do? It was how much? 60,000. So I will have 60,000 minus what? 10,000. What's the net balance? 50,000. This is the balance that I will add to my capital employed. Are we together? That's first scenario. Scenario 2. R&D of 60,000 was charged to profit above. Of how many years? 6 years. And I have 2 things to do. How much did they charge? They charge the entire 60,000. What do when I'm doing my no part? Number 1 thing is add back. Expense what? R&D. How much is it? 60,000. Now that you added it back, you've neutralized that nonsense they did, Abby. The next thing now is to do what? Capitalize it. Amortize it, Abby. So let's amortize R&D. How much? That's 10,000, Abby. 60,000 divided 6. How much? 10,000. I'll take it out. I'm done with this. And then I'll now go to where? Economic capital employed. How much do I have? R&D. How much? 50,000. Close. Good. So it simply means that anything you're doing to R&D, to your lease, depends on the treatment that you can see in the statement. Are we together? I will show you when we start working now. In fact, in 2023, November, the only thing they did was just adjustment for 20 marks, how to adjust R&D, prior year R&Ds and all of that. That was all that they did for them. And I'll show you that question in a bit. But do we all understand this? Yes. Yes. Lease is straightforward. Lease, you are not amortizing anything. When you have lease, the only thing is when it can be expensed, what do? Add it back. Carry the same amount and take it to where? Capitalize. You are not amortizing. That's the only difference. A depreciation is a different treatment on its own. Yeah. Yes. Not cash expense. Yes. Cumulative. Capital employed. Fantastic. Non-cash expense relate to one accounting period. We are saying add it back to the profits of that year. When you talk of cumulative, remember, over the years, you've been doing the wrong things. That wrong thing, you see it in your balance sheet. That's the cumulative. The cumulative value cannot be corrected on the current profit or loss. It's not like there's a prior year error or something like that. You close the books for 2024, 2023, and then you see an error. Can you go and open that financial? Where will it affect? It will go straight to your retained earnings or general reserve and the rest of them. So all those impacts go into your capital employed. So you can't affect it on the profit of those years because they are closed. Remember, profit is one accounting period. So where there are cumulative errors, they can only be affected on the balance sheet, not on the profit. Do you get? So that cumulative is just to correct the prior year errors, and it can only be in capital employed, not profit. But the other one is for that year. All right, so let's move to, I think we are done with this capital employed. Okay, so let's give adjustment for capital employed. For economic so I will have capital employed at, don't forget, beginning of year. Chen, add non-capitalized lease. Chen, add net balance of R&D. Chen, and then add cumulative non-cash expense. Chen, chi. This is economic capital employed. No thinking. Past PM is not connection. Easy. You don't need connection to past PM. Abi? You believe it? Sharp. I'll show you a question now. Free 20 marks, you do it yourself. 20 marks for doing nothing. Kinaji? You speak Hausa? So say? Yo. Kanaji Hausa ni? So say? You know, where are you from? I don't know, okay. But I used to actually think that everybody in the north speak Hausa. That in the sense is not true, right? All right, so let's look at a question. Online, are we together? Of course, our work is still work. That's the only thing we've not done, Abi. Look at. Work is still work. Nothing is changing. Remember this work, Abi, from your residual income. It's still the same thing. It's not changing. So the only thing we are adjusting is no part and economic capital employed. And I've told you, all you need to do is understand this adjustment. Understand that. Don't cram the adjustments. Why I'm saying you should not cram is it is possible if I'm the one setting, but they said if you are teaching, you cannot set. Because if I'm setting, what I will do really is that I've seen a question where they say depreciation was not treated. I don't know if you get. You know, I know that I should add backwards accounting depreciation, Abi, but they told me in the notes that depreciation was not treated in the account. If they have not treated it, do I need to add it back here or deduct anything? No. Why? Because it wasn't part of what they charge deposit or lock. so I should ignore it. So it means that your understanding of all these items in the financial becomes very, very important. So let's look at, I think 20, what diets? I think 2019. Is it 20? Okay, what diet is this? Yeah, May 2019 diet, question 2. May 2019, question 2. Are we there? May 2019, question 2. If you are there, I'm there. Yes. Please don't forget, for those that have not seen the smart notes. How many do you all have the smart notes by now? Yes, please, if you don't have the smart notes yet, go to the group and get it. Just, I think it's about 90, just 90. I'm very interested. It's like reading a romantic novel. Very sweet. Short stuff, and just try
Sir,
and
please,
go
can you
through.
drop this question on the WhatsApp group?
Okay, I think, can somebody help us share it? 2014. Somebody help us share the question, please. 2019 May diet question 2. Are we there? Online. Do you have a question?
Yes, sir. Yes,
All right.
I am.
Are we all there? You have a question? Why? With the group. If somebody is sharing the question, open it. Are we there? All right. Peter Drucker find that until a business returns a profit that is greater than its cost of capital, it operates at a loss. Therefore, experts have challenged accounting profit as a good measure of increase in value of business and have proposed a measure of real economic profit. In their view, this will lead to a better measurement of the increase in value of a business during a given period of time. One method has been suggested to measure economic profit is known as economic value added, EVA. TIS Nigeria Limited has presented the following income statement and statement of financial position for the year ended 31st December 2018. Income statement. Profit before interest and tax, egole, 75,000. Interest cost, 9,000. Profit before tax, now 66,000. Tax at 30%. Profit after tax, how much? 46. Then you have dividend and then you have retained profit. All right. So if you're a student of this class, you should know that these two guys are just giving to you for what? Distractions. Why are they distractions? They don't have anything to do with us. Abi? So our adjustment will start from where, guys? Profit after tax, which is how much? 46,200. Fantastic. Now, statement of financial position. You have non-current asset, net current asset. Now, remember, statement of financial position for which year? 2018. Please take notes now. If this is 2018, it means that everything that you see here are all closing. Are we good? Right. So I will have that at the back of my mind as I'm reading the requirement. Now, non-current assets, current asset, total asset, shareholders fund, long-term and medium-term debt, and then capital employed. Now, remember, this capital employed is what? Closing capital employed, right? Now, capital employed at the beginning of the year was how much? 420 million. The company had non-capitalized lease asset of how much? 24 million in the year. These assets are not subject to depreciation. The estimated cost of equity in the year was 10% and cost of debt was 7%. The company's target capital structure is 60% equity and 40% debt. Accounting depreciation was equal to economic depreciation. So there's no need to make an adjustment for accounting depreciation to get economic depreciation. Why are they even telling you? You understand what they are saying here? Remember, what do you do? Accounting depreciation, you add back, you deduct economic depreciation. So if they are now the same and you add back and deduct, nil effects, they are not telling you that because they are the same, there is no need to make adjustment. Other non-cash expense, how much? 16 million. The company has decided to evaluate its performance using what? Economic value added approach. You are required to discuss the perceived benefits of what? Using EVA. And then B, calculate what? Real economic profit using what? EVA. What you do for me is simple. First, let me get your work, everybody, from this question. Get me the work now in 3 minutes. Everyone, work starts now. No hiding place. What happened? You don't have the question. Even those that said the rest what we did yesterday, they are opening their notes to remember the formula. Oh yeah. Live
Have you
question.
sent the question to our WhatsApp?
I saw somebody already shared. Please check. Are you on WhatsApp, on the WhatsApp group?
Yes, sir.
Okay, please check. It should be there. Any problem? What's the problem? Tell me. Times 60%. So anyhow you do so yes, any problem? What issue? Yes. 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 Nothing personal. Any issue? You need to know. Okay. No. Ah. Hey. Hey. You don't know what the problem is. Hey. So. Hey. Okay. Let's move. Let's do it together. I think we are overthinking this thing. We are overthinking it. All right, so let's quickly do it together. Illustration 1. Teas Nigeria Limited, Abi. And this is don't forget the A part is already in your note, Abi. Please also make up your notes. You can check the what's it called? The smart note in case you want to get more points. Just check the smart note, but the A is already done. This is November, May 2019. Question what? Question 2. A, that's A, as in your note. B, calculation of EVA, right? And I know that EVA equals to what? No part minus what? Economic capital employed multiplied by what? Weighted average cost of capital. Now let's start with this work. Note 1. Work. Weighted average cost of capital. And this formula says work equals to cost of equity multiplied by what? Value of equity over VO plus what? Cost of debt multiplied by value of debt over VO into 1 minus T, where KE is what, guys? Cost of what? Equity. Is it given to us in this question? What is it? 10%. KD is what? Cost of debt. Is it given to you? How many? 7%. See where the problem is, you're overthinking it. For PM, I already told us that this structure, this VE over VO is what you call capital structure. What is capital structure? The percentage that equity has to the total value of organization. What is this one? For debt, is the percentage that debt has to what? The total value of the organization. And I told us that for PM, you will not be asked to start calculating value of equity, value of organization. You don't need it. What they will give you exactly is that they will give you a capital structure for equity, meaning that 60% you're seeing is this percentage that they're giving to you. They are saying the ratio of equity to the total value is how many percent? 60%. So it means that my VE over VO is already given to me to be how many percent? 60%. And my VD over VO is given to me how many percent? 40%. And my tax rate is how many percent? 30%. Nothing more. What do I do? WACC equals to cost of equity is how much? 10% multiplied by what? 60%. Plus cost of debt, 7% multiply 40%. Sabi book. Into 1 minus what? 0.3. That's all. Yes. Value of organization, that's what you call capital structure. Capital structure for equity. And this one is capital structure for what? For debt. Could you be alone now? Good, everyone? All right. So if you have a Casio calculator, help me. What figure are you seeing on the calculator? Final. 7.96%, assuming this figure is correct. So the next thing is to go and adjust for my what now? No part. Is that not? Now let's go. Note 2. Is that not? Either way, it doesn't matter. It's just to know how to use it. If it's percentage, when you bring it to your formula, you know how to apply. Abi? It doesn't matter whether you put it in percentage or you leave it. Absolutely, it doesn't matter. But you must understand how to use, right? Note 2. Adjustment for what? No part. Remember the format? We always start with what? Profit after tax as per what? Question. Egone. Are they working in thousand or million? 1,000. 46. So what do we do? Add back. What are we adding back? Non-cash. How much is it? Non-cash expense. How much is it? 16,000. What else? Is there no, there is no adjustment for that? Then there's which other one? Now look at what you do here. Before you even go to the notes, I think it's safer for you to start from here. Look at all the items that are before profit after tax, so you don't miss anything out. Now, these are the only things that they've expensed before this profit after tax that we can see is actually what? Interest cost, Abi, and then we have adjustment for interest cost. So let's deal with that. So we add back interest, net of what? Net of tax. How much is the interest? 9,000, Abi? 9,000 multiplied by 1 minus 0.3. So 9,000 multiplied by 0.7, help me. 6,300. Now that we are done with the items before profit after tax, let's go into the notes and let's see the adjustment we have. This adjustment, capital employed at the beginning, is not affecting capital employed. Next one is what? They have non-capitalized means in the year. Non-capitalized means they've not treated. Abi? So will it affect our profits? No, it will not. Next one, we have dealt with this, Abi. We have dealt with this. Next one is accounting depreciation, nothing again. And we have done this already. Abi? What else is left? Nothing. 10 marks for doing nothing. Figure. Help me. 22,300. Add it to this profit after tax. What do I have? This is no part. 68,500. And I'm done with this. So note 3 will be what now, guys? Economic capital employed. Oh, Gucha. So note what? Note 3. Economic capital employed. Remember, your capital employed must be capital employed at when? At the beginning. So capital employed at the beginning. Don't forget, at the beginning. Egone, 420,000. What can I see there? Add non-capitalized, Abi. Non-capitalized lease. Egone, 24,000. Any other item? Ladies and gentlemen, nothing. That's all. I go live for you. Sam now. Yes. Fantastic. Yes. Anyone? Okay, you want us to work together? Okay, sir. Right away. Work with me. 2 things. If I want to be very fast, I'll just leave one of these things in percentage so I don't worry myself. Or you can start to convert everything to random figures or normal absolute values and then do them multiply again by 100. But the approach I adopt is I just leave this one, this cost in percentage, meaning what is 60% of 10? How much is it? 60% of 10 is how much? 6. So that means I will have 6% here. Abi? Plus. I'm leaving this one also in percentage. So what is 40% of 7? 2.8 multiply. This is percent, right? Multiply by 0.7. Help me. This is 6% plus 2.8%. What's 0.7 times 2.8? I'm sure it will be 1.96%. 7.96%. Yeah. So I think we are done with this guy. Then we have economic capital employed. Egone 444. Like this. Fantastic. Next, my EVA equals to no part, Abi, minus economic what? Capital employed times what? What? Figures already completed, no part. Don't forget EVA value in what? In 1,000 equals to. Yes. We don't have it. Yes, we'll see other questions. Don't worry. We don't have it. So I gave you all those things just in case you see questions that I have 1 or 2 of them, right? But it's not in all the questions you see there. What's the no part? Help me. 68,500 minus 444,000 multiply WACC we're going 7.96%. Could you below help me? Igor. No. This is 68,500. 7.96 of 444,000. Are you sure? Okay, 33,155.157. 157. Okay, so let's just round it up. 157, Abi. Like this, Abi. Like this, Abi. Is it positive or negative? Positive, Abi. All right, so let's put the comment. Since the EVA is positive of how much? 33,157,000. It means that T's Nigeria Limited has created value. NB. When EVA is negative, it means that the company destroyed value. All right, so take note. When it's positive, value has been created. When it's negative, what happens? Value has been destroyed. Yes, question? Yes. Fantastic. Yes. What did I write in the note I gave to you? Read it the way you have it in your notes. I'm interested. When a list has been expelled, yes. Why you adding it? Because it's not supposed to be expelled. You want to correct that error by adding it back. What is the special treatment for list? Capitalized. In this question, we didn't expel it. They only told us that it's not being capitalized. And what we did was to just simply capitalize it, move on. Sorry, after no, hold on. What does it mean to capitalize an item? Capitalize, add it to balance sheet. It should not be part of your profit or loss. Capitalize. When you buy a motorcycle, it's expensive. The process of adding it to your PPE schedule, it means you are capitalizing it because it's supposed to last for more than one accounting period. That's the word capitalization when it comes to ever means add it to capital employed. Remember, your capital employed is total asset minus final liability. So when you're capitalizing it, like you're adding to that total asset. All right, so let's give us get one assignment quickly, and it will be passport to your next class. And that's 2023. 2023, yes. Which one? No, what your calculator is saying, is it positive or negative? It's from your calculator, sir. Yes. 2023. This 2023. What direct is this one, sir? Yes. March, July 2020, question 4. March, July 2020, question 4. Question 4. All right, so we ended the class here today. Be nice having you in class. See you when I see you. Enjoy the rest of your day.